Well, hi there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It is just a little after 2 p.m. Pacific time here. Sorry for a briefly late kickoff, but welcome and thanks for joining me today on the show. We're coming to you live from a beautifully sunny, not too hot, not too cold, just right, Redmond, Washington. Hope everyone is doing well, staying safe, staying warm or cool or whatever is helping you these days, wherever you're at. Markets, bit of a risk-off feel to the tape today. We're going to talk about a bearish engulfing pattern emerging on some of the major U.S. averages. We'll talk about defensive sectors pushing to the top of the list, with real estate and utilities taking the top two spots. We'll talk a lot about earnings, and we'll go through some of the big earnings releases here coming up in the next 48 hours, including 4 of the Magnificent 7 stocks going out with their earnings report. Earnings have been heating up so far this week. A number of stocks getting dinged today after their most recent earnings release. So a lot to cover with you. We're going to get to the charts, and during earnings season, we usually spend a little more time on individual stocks just because that's where there's a lot of movement. So we'll take a look there. As a reminder, we are live streaming on Facebook, LinkedIn, YouTube, and X. Thank you so much to those of you that are tuning in live. You are welcome to ask questions as we go. Anywhere where you can drop a comment on one of those platforms where you're seeing the stream, you can drop some questions there. Otherwise, if you're watching our replay on our YouTube channel, just pop a question in the comment section. We'll do an all mailbag episode on Friday, and we'd love to answer one of your questions on the show there. Looking at the major averages, story of today was a higher open and a lower close. And if you think about what happened yesterday, was sort of a late stage rally after drifting lower. Today's higher open pushing just above 6,400 to the lower close, finishing the day around 6,370. That results in a bearish engulfing pattern with a wider range but a down close on today's action. Suggests the next 1 to 3 bars more likely lower. And this is going into some pretty serious earnings. Also, the Fed meeting, also the latest inflation data in the form of the PCE data coming out, I believe, on Thursday. With that in mind, the S&P at the end of the day closing around 6,370. That's down about 1/3% from Monday's close. The NASDAQ composite down 0.4%. The Dow Jones down about 0.5%. All the major averages down, not a ton, but just slightly. Kind of makes sense. This is sort of a bit of a wait and see mode. I mean, a lot of companies moving quite a bit today on earnings, but the major averages still tied very much to the Magnificent 7 stocks. We've got 4: Apple, Amazon, Meta, Microsoft, all reporting in the next 2 sessions. So a lot of earnings to digest. The VIX moving about a full point higher today. We're still in a low volatility environment with the VIX below 16. But we're sort of, we're moving in the wrong direction if you're bullish here, with the VIX starting to spike higher. By the way, had a really interesting interview earlier. Actually, it was yesterday. I spoke with Callum Thomas, who is the author of Top Down Charts, based in New Zealand. He's a macro strategist with a quite a technical feel to a lot that he does. And we talked about seasonality for the VIX, which is interesting. I haven't talked about that with a number of people. So it's kind of interesting looking at some charts together and talking about what that might mean for the markets in August and September. I mean, general observation is just as risk assets tend to struggle in August and September, the VIX actually tends to increase, which makes sense. So for now, popping a little bit higher today. So this was not an end of the world day. And again, we're at or near new all-time highs this week. But the bearish engulfing pattern, the defensive feel to the tape today definitely felt like a risk-off move going into, sort of a news-heavy 2 sessions with earnings, the Fed, economic data. Bonds rallied today, so you have stocks slightly lower. Bonds, decent upswing. The TLT was up about 1.7%. That's bond prices. The dollar was up slightly, so you have dollar rallying this week. You have bonds going up this week. We have rates coming down as a result. And, we have a chart looking at bonds and the dollar. Sort of implies you have non-U.S. investors starting to buy U.S. debt, maybe is what we infer from those two things. We'll look at the chart together and talk about what that might mean. All right, looking at the commodity space, the commodity ETF, the DBC, having a nice up day. Crude oil prices having a very strong day with the USO up over 3% today. Gold and silver slightly higher. The GLD was up about 0.3%. Silver essentially flat for the day. Most of the commodity space having a decent update. Cryptocurrencies not as much, right? So cryptocurrencies matched more the move in the equity markets. Bitcoin, Ethereum down slightly, less than 1% here from yesterday's close. And overall, you can see most of the top 10 coins sort of drifting lower today. All right, let's look at the 11 S&P sectors. And by the way, I do see a comment about it's not Fleet Week. What do we call it? Seafair Weekend here in Seattle. It's a big, air show, air sea kind of show. My son and his mother, they went to a Seattle Sounders event this morning for the kids club. Got to meet a bunch of the players, which is cool. And then they had Blue Angels flying over the field as they were meeting all of them, which is pretty cool too. So they're ecstatic, over the moon about that experience. Back to the charts. Defensive sectors at the top of the list today. We've got 5 S&P sectors, really 4 higher, 6 lower, 1 literally dead even. Technology, the XLK finished a penny away from where it was yesterday. So the 4 sectors that actually managed to gain today: real estate up 1.7%, utilities up 1.2%, energy up 1%, consumer staples up 0.2%. So 3 of those 4 sectors are pretty much the defense, right? REITs, UTs, consumer staples, energy, more of a cyclical sector, more of an economically sensitive sector, but also moving higher with crude oil prices starting to rally. So generally, this is sort of a defensive feel. A lot of technology earnings this week, particularly tomorrow with Microsoft, Thursday with Apple, but the XLK was flat today going into those reports. Industrials, the worst performing sector, not a huge down day, down about just over 1%. Consumer discretionary and communication services down as well. Meta not having a great day going into earnings this week as well, down over 2-3%. I noticed. We'll see that here in a moment on the heat map. All right, looking at breadth conditions, I mean, kind of okay to not okay, depending on which bucket we're looking at. On the New York Composite Index, really a coin flip, kind of a 50-50 between advancers versus decliners. The NASDAQ Composite very much favoring decliners, almost 70% of the index down today. S&P 500 flat. So, breadth was sort of neutral for the New York Composite Index, and for the large cap space, for the NASDAQ, mid cap, small cap, definitely much more of a distribution day in terms of decliners, far outnumbering advancers. Looking at individual stocks, you have Alphabet rallying 1.7%. That's going into their earnings release later. Is that true? No, Alphabet already reported. They were last week. So Alphabet actually gaining post earnings report, continuing that uptrend phase. Broadcom up 1.1%. They don't report until later in the season. Microsoft flat. That's going into this week's earnings release. They're tomorrow. Meta, here we go, down 2.5%. Tesla down 1.4%. Apple down 1.3%. So some of these big names getting ready to report earnings, not great, kind of flat to kind of down to big time down. Some things certainly to pay attention to. At the end of the day, it's all about what happens, of course, post earnings. But we'll talk about the trends going into there, because that will give you a sense of sentiment and investor biases going into that release. All right, let's look at the heat map. As a reminder, I do see some questions coming in already and some comments on here along the way. I did grab a bunch of individual stocks here to go through in a moment, but first we'll talk about the market carpet, which is a heat map style visualization. Any other comments or questions that pop in your head as we're going through the charts, please pop them in to the comments. If you're watching the show live, we'll grab a couple of those at the end of the episode. Any of the questions we don't get to, we'll put in the mailbag and address on Friday's show. Looking at the heat map here, I mean, I'm struck by some names that are down quite a bit today, right? And so this definitely feels like a bit of a distribution day. Now, before we get to those names that were hit pretty hard, look at the things that were up. So there were things that were up, and it's the sectors that have been struggling, right, on a relative basis. Consumer staples, real estate, utilities, those are all kind of on the right third of the heat map here. These are smaller sectors. These are lower volatility sectors. These are higher dividend paying stocks. And these are sectors that tend to do well when the market is not doing well. These are sectors that tend to outperform in a down tape. And so today, really fulfilling that role as a defensive sector. I mean, a number of the REITs, especially, right, having a really strong update. I mean, look at all the names that are up multiple percentage points. Now, balance that with the fact that besides like Alphabet and Broadcom and like Oracle, the average kind of large name in these big growth sectors did not have a very strong day today. A number of these down quite a bit here. You have Palo Alto Networks down over 5%. This is after a series of attempts to gain a foothold above $200 a share, not really getting any momentum there. Uber really starting to roll over after topping out as well. Now, on the other side, right, of course, you've got names like Synopsys making a new all-time high today, up over 7%. Cadence up almost 10%. This thing's going full vertical after breaking to a new 52-week high about a week ago. Charts like this are the reminder as to why I learned a long time ago to look for the new highs list. Back in the day, when I was first learning about investing, I would think of the new highs list as a sell list, right? That was my watch list of potential shorts. I would be looking to sell into strength. That was great in like 2001. You got your face ripped off during a bull market phase using that kind of strategy, right? Selling severe strength is good during a bear market phase because there's just not a lot of buying power really pushing assets higher, and generally bounces higher or counter trend moves before they rotate lower. But in an extended bull market phase, you generally want to be more buying the new highs list, not fading the new highs list. And so, and this is something I learned from years at Fidelity. Once I started working for growth investors, that would show me that new 52-week highs can often lead to many, many more new highs for months and years, if not decades down the road. And so, looking at the new highs list and thinking, all right, these are some stocks that are starting to work. Should I own any of them? Eventually got me to a screen for the new three-month highs list, which is what I run every week, looking for new emerging strength and looking for emerging breakdowns. We can see a lot of breakdowns, speaking of which, in the consumer discretionary sector. It's not as much the big names, but some of the gambling names like MGM, Caesars, all dropping today. Cruise lines like Royal Caribbean down about 5% after making a new 52-week high earlier this month. Within the industrial sector, a number of things coming down here. Johnson Controls, Boeing, big, obviously a big Seattle company, coming down pretty aggressively today. UPS down over 10%. UPS looked like a pretty encouraging chart, although over the last week, we've made a bit of a lower high, right? We sort of stalled out around 105. Today's drop puts us well below 100 and close to a new 52-week low for UPS. UPS is one of those kind of bellwether stocks. The fact that UPS has been trending higher from the April market low up until this week has been fairly encouraging. I was taught, years ago, sort of like what important names help you understand the state of the economy and the state of the consumer. UPS is one of those kind of good shipping companies where you get an idea of demand, you get an idea of supply. If it's all working well, UPS should be doing pretty well. If people are buying stuff and getting it shipped to them, chart not looking good all of a sudden and starting to look much more like a negative chart versus a positive chart. We don't have time to go through all of these charts with a lot of movements, but I will tell you every one of these red boxes has a story behind them, and I would encourage you to dig into some of these charts. And all I will tell you is with some of these stocks that have had huge moves to the upside or the downside, remember, make short-term decisions with short-term data, make long-term decisions with long-term data. I would encourage you to pay less attention to one day's move and what that means. Think about what one day's move means in the context of the overall trend that we're trying to understand. That's where you can really understand if a move on a day like today is significant in terms of changing the character of the chart, or if it's just a natural up and down swing within a larger trend that we can start to quantify. All right, let's get to the charts, and then we'll take a couple questions, and we'll call it a day here. The S&P 500 flashing a bearish engulfing pattern. I have a chart. I don't know if I have a chart in a minute or two. I think I do, but if not, here's what a bearish engulfing pattern. It's not a perfect one, to be honest with you. A perfect bearish engulfing pattern would be a big up day and then a big down day. The up day's real body open to close is engulfed by day two's real body open to close. This is a little more of a down day and then a down day. So you probably more call this an outside day, which honestly is not that much different. That's sort of a bar chart technique where you talk about outside days. That's where the range gets a little wider, and we have a reversal day. It's bearish too, and suggests again, kind of the next 1 to 3 bars are more likely lower. If this does lead to further distribution with the Fed meeting coming up tomorrow, I mean, it's happening now, but the Fed press conference and all of that tomorrow, with earnings, with some big earnings in the next 2 sessions. If we do see distribution, I am laser focused on the 21-day exponential moving average. That has been quite helpful in May and June lows, and even in July, as we've remained above that upward sloping 21-day EMA. Once that stops being the case, then we can start talking about a distribution pattern that's really starting to get more to a concerning level. For now, this is short-term distribution within the context of a long-term upturn. We made a new all-time high today, trading above 6,400 today. So, I mean, let's not get too negative, but it definitely suggests a bit of at least short-term distribution for now. We talked about the dollar. We talked about rates. This is the dollar in the top panel, $ USD on stock charts. The dollar index has different tickers on different platforms. That's not one that's particularly standardized. It's up to each charting platform to decide how they want to actually tickerize some of these things. On stock charts, it's $ USD. On other platforms, it's DXY, the dollar spot index. I would encourage you to explore whatever platform you use for charting. They probably have a dollar index. And if they don't, use the UUP, which isn't perfect, but it's a dollar ETF that's pretty close in terms of tracking the movements of the US dollar. You could also look at the euro if you can easily access that, and just think of it flipped over, because the dollar index is pretty much the inverse of the euro because it's the biggest weight in that calculation. Look at the chart of the dollar here. We've been in a clear downtrend in 2025, right? Lower highs, lower lows. We broke below the 50-day moving average briefly in January, full time in February. And we've remained below a downward sloping 50-day moving average with a number of counter trend tests of that moving average until this week. Yesterday, we closed back above the 50-day for the first time since February. And today we're pushing that further to the upside. This gets much above 99, which would be just a hair above today's close. I think that completes a rotation from a distribution phase or a downtrend phase to an uptrend phase. So the situation you have now is the dollar rallying. This bottom panel is the bond ETF, the Treasury bond ETF we like to track, ticker TLT. So this week we have bonds rallying, we have the dollar rallying. What you could infer from that relationship, for those two movements, is that non-US investors getting a little nervous, converting to US dollars to buy US debt. There's no guarantee that that's what's happening, but the move that I'm seeing in both of those assets this week, lining up so well together, suggests to me that maybe that's at least part of what's going on here. So certainly an issue to keep in mind. And again, we're going into heavy earnings this week, of course, a lot of economic data, the Fed meeting, but also the seasonality, right? Once we get through July and we're into August and September, this is when markets usually do not look particularly good. I'm not the only one that is pretty clear on that seasonality that tends to happen. Maybe other investors starting to position themselves a little more defensively. We certainly saw defensive sectors rallying today as well. We'll keep an eye on that theme and share some observations as we go. Boeing distribution day. This is where you have a very clear bearish engulfing pattern. Yesterday was an up day. Today was a down day, day 2. The open to close, what's called the real body of the candle, engulfs day 1's real body. Stock's down about 4+% today. That's a bearish sign from Boeing coming out of their earnings release. So not great. I mean, again, it's still a decent chart. We again made a new high today. But the weaker close and the bearish engulfing pattern, again, suggests some short-term weakness. We're kind of right at the 21-day EMA. It's not shown on this chart, but keep an eye on that 50-day moving average to see if we can hold that if we do get further deterioration. UPS has been not a great chart for a while here. We talked about this rally from the April low to where we've been at. But to be clear, last year was not a good year. 2024 was a rough year for UPS. Consistently below a downward sloping 200-day moving average. Here's the relative strength, getting absolutely clobbered. That just continued in 2025 like nothing's different. Today's drop really just, I think, further validates the fact that UPS is still in a primary downtrend below now all the moving averages and still below a downward sloping 200-day moving average. That's not good for UPS, and sort of suggests a lack of optimism about growth prospects going forward. PayPal, I mean, while UPS has been a weak chart for a while, PayPal up until today, one would argue a very encouraging chart. We've highlighted the fact that that PayPal got back above the 50-day, had a number of pullbacks to the 50-day just in the last week, has finally gotten back above the 200-day moving average. What I often say in that situation is the break above the 200-day is super bullish. That's encouraging. That means there's optimism. That means there's accumulation. So we want to make sure that we hold the 200-day, because if we don't, that's a failed breakout. That's something we want to avoid. But if we do hold the 200-day, that says there's more momentum coming. Today, confirming we're not holding the 200-day. We're back below that. We're back below the 50-day moving average. This stock went from pretty encouraging, probably a very buyable chart, to a questionable chart with today's breakdown, a gap lower. That's why you have stops. And if you did, buy into this break, I don't blame you. I don't think you did anything wrong by recognizing a break above the 200. I think that's a pretty good breakout. The reality is sometimes it doesn't work, and make sure you have a good stop in play. Most likely, with the stock down over 8% today, you probably get stopped out if you did buy into that breakout. We'll have to take time and reassess what sort of pattern emerges. All right, we have a couple names reporting after the close today. Starbucks is one. Booking is another one. We'll start with Starbucks. I mean, kind of an okay chart. I mean, I would say this is a definition of an okay chart. A good chart is above upward sloping moving averages. A bad chart is below downward sloping moving averages. An chart, a neutral, is between the moving averages. The moving averages are flat, and that's kind of what we see ourselves. You think of this kind of chart, you draw kind of a rectangle. If you'll indulge me for a minute, what I like to do with this kind of chart is literally draw a rectangle on the chart itself. I'll go with something like this, make it a lighter color, no border. We fill it up. And then you just kind of draw a rectangle around the price action. This defines the range that Starbucks has been in here for the last, 6 weeks or so, right? We have clear support around like $90-ish. We've got clear resistance around 97, 98. This is the kind of chart where I'm patient. I'm sitting on my hands and I'm waiting, because one of these two things is going to happen. Either we break above the upper boundary, which would be pretty encouraging, right? If we do this, sort of push out that way, that suggests, accumulation, buyers finally taking control, getting us out of this range, basically implies that new buyers are coming in, a lot of optimism, super encouraging. On the other hand, if that happens, which is a breakdown, that's the opposite, right? That tells us, no, we're distributing. We're actually breaking below the 50-day moving average. We're making a new swing low. So this is the kind of thing I probably wait. I don't think the chart has a clear directional call. The direction is sideways. And what you do are you set alerts. All right, if this gets above 98, that's a buy signal. If it gets below 90, that's a sell signal, or that's how I would tend to interpret it. And then you start to determine whether you want to take a shot given its opportunity relative to other charts that you're looking at. So the question is, which way does it break? Does it break? And if so, which way? Let's see if they report, because I think they were after the close today. We'll take a look, see how the Starbucks up a little bit in the aftermarket, right? We're up about 3% after reporting earnings here. We're on 95.60, which means we're currently still within this rectangle, kind of right around there. So not enough, in my opinion, to say a clear bullish chart. So the way that I think about charts and trends is at any point, a chart is one of three directions. It's going up, it's going down, it's going sideways. Or as I describe it, it's in a period of accumulation where we're going up. It's in a period of distribution where we're going down, or it's in a period of consolidation where we're going sideways. This is a chart going sideways, and you just set guardrails as to what would tell you we're going from consolidation to accumulation. That's above 98. Consolidation to distribution, that's below 90. It's a wait and see chart, I would argue. All right, booking.com, pulling back to the 50-day moving average. That's a pretty interesting setup. This is one of those where if it's the buy on the dips moment, we're kind of there, right? Because if you get much below the 50-day, it's no longer feeling like a buyable dip. It's feeling more like distribution, right? When you have an uptrend like this, pulling back to moving average support can be super encouraging. We start breaking below the 50-day, though, it tells you maybe this is something different, not a buyable dip, but now sort of a corrective move. So I would say for now, booking at a really crucial moment. And the question is, do we hold that 50-day? Looks like aftermarket, we're down about 2.4%. It's around 54, 55. So we're currently below the 50-day moving average. as I've mentioned many times, I'm not a big fan of drawing too much data from or too much information from after hours trading. It's good to see an initial reaction and whether generally earnings went well or went poorly, and whether there's optimism or pessimism and what's that changing. But I think tomorrow's session is where you really start to understand, once investors can kind of determine how they feel like whatever earnings release is going to impact booking. We'll see where the market opens tomorrow and what happens in tomorrow's session. But I would say getting below the 50-day moving average this week would be a fairly negative sign for a chart that has been quite good. What concerns me about this market, and I've mentioned a number of these things, right? I mean, as always, when the market's going well, you look for signs to be concerned about. For me, charts like Spotify breaking down in the way that I'm seeing don't make me feel good, right? And we've seen that with communications names like a Spotify, which is in the communication services sector. We've seen that with some technology stocks we've seen with some industrials that have been really good charts, clear uptrend phases, higher highs, higher lows, everything's sloping upwards. It's outperforming. Spotify's been a banger for 2 years. I mean, it's been an awesome, awesome chart until the end of June. And from July 1st to now, it's basically been pulling back. And that initial drop to an ascending moving average is not that bad. But when we don't hold support at moving averages, and then we have a day like today where they're lowering guidance, missing earnings, and whatever else causes the price to gap down to close about 11.5% below yesterday's close, that's not good. Now we're getting near to the 200-day moving average, which is where the long-term trend, you have to start determining that that's really shifting. But for now, I think that's when we talk about some of the rotation, some of the leadership rotation that we're seeing. Charts like Spotify are certainly top of mind. These are charts that have been so good for so long. And when they're no longer so good, then you have to think about, well, what does that mean? Where are assets rotating? If people are selling Spotify, what are they buying? And I think at this point, if people are selling Spotify and buying, an industrial stock, or they're buying energy, or they're buying financials, that's not bad. That's just rotation from sort of growthy leadership to value leadership. But if they're selling Spotify to buy treasury bonds, if you're selling Spotify to buy gold, if you're selling Spotify to buy defensive side, right? Utilities, right? Selling the juice, selling your top performer and putting that in an income producing asset because you just want to ride out a period of market uncertainty. That's where the indexes start to feel a lot of pain very, very quickly. And now how do you tell if where assets are rotating to? This is why we look at the charts, right? This is why we look at the chart of gold and bonds and the dollar and the S&P and the NASDAQ and Spotify and the XLU and the XLK. By analyzing these price movements going forward, we should be able to assess if the price of Spotify is going down, something's probably going up somewhere. Let's focus on what it is. For today, at least for this week, it's the dollar, it's bonds, it's gold maybe, but it's not Spotify, right? It's not some of these leading names that have done so well. More to come, of course, as we get through more earnings. And the chat here was lighting up on YouTube as we're going. A lot of debate and discussion about the Fed and what may come. I'm going to skip any political questions I don't really want to get into, but I will grab a question or two on charts. Why not? Akira-san, thanks for watching on YouTube. You asked your thoughts on the use of Ichimoku Cloud. Do you use them? If yes, when is it useful for your good charts? Thank you for great sessions. You're welcome, my friend. And thank you, as always, for watching and for asking thoughtful questions all along the way. I do look at Ichimoku charts, but not often, not all the time. The way that I have learned to use technical analysis is in a way that I would, basically encourage people to do, right? I think as you get started, you probably use whatever a mentor or whatever the guy next to you on the desk or whatever book you read first, you kind of use whatever they talk about. And that's kind of your starting point. That's good. That's what, at the early stages makes sense, right? Use something, start to learn some lessons and see what happens. But as you grow as an investor, you really want to open your mind to other techniques and tools. For me, the CMT exams and getting that designation was super helpful because it forced me to learn all sorts of different technical approaches that I didn't understand. I also worked for Bloomberg, which meant I had to understand all of the charting tools we had on the platform because I would often have to teach people about them or get obscure questions asked about calculations of different things. So I had to know that part of the platform incredibly well. So I had to learn everything. So I learned, I just was a sponge for anything about charts and technical analysis. And I think that's a natural kind of second stage, kind of like the sponge stage, where you're just gathering ideas and hearing a lot of things. But then at the end of the day, you have to move on to that next stage, which is I actually need to make decisions using these tools. I have to simplify. And so I find a lot of times people have this natural progression of learning technical analysis where they start kind of simple. It gets way too complicated. And you wake up one day and you're like, wow, I need to just super simplify this thing. I need to clean my desk off and I need to limit it. And so that is what I've done over the course of my career. So I've boiled it down to this chart, which is kind of my go-to chart. If you ask me, what do you think of Spotify? I will bring up this chart with about a year and a half of data, with 3 moving averages, with RSI to check momentum, with relative strength to check performance. And that's where I start. Then based on what I see here, I might bring on other charts. So I might bring up volume and look at things like Chaikin money flow, or look at things like accumulation distribution, or look what sort of big up days and down days and what they're doing. I might look at comparisons and think, how does this stock compare to something else, and start to line up and look at how it may be trading relative to its peers or something like that. Or I'll look at the Ichimoku cloud, which is this chart that I have here, and I'll bring that up. This actually, Spotify is one of those charts where I would probably bring it up, because sorry for a long-winded answer to your question, Akira, but you asked about the Ichimoku cloud. What's great about it is one of the few technical indicators that is actually plotted in the future. It actually, part of it, this cloud part, has 2 different lines, which are calculated from the current and recent price data, but it's plotted 26 days in the future. This cloud is part of a much larger, Ichimoku chart system, really, that has 3 different components. There's a lagging span that's plotted 26 days in the past. There's the, what are those 2 names? The conversion line and the baseline, that are 2 different, kind of a crossover trend following thing. And then there's the cloud, which is plotted in the future. And the idea is it gives you a sense of where you could anticipate potential support and resistance in the future. So what's cool is when you see the price come down to the cloud, you have to remember that this cloud was here, like back here, you actually had an idea of, if we do sell off, that's probably where you get some support. It's amazing how it often will find support at the cloud that was plotted almost a month ago. So the problem for Spotify is literally in the middle of the cloud. And if it is unable to hold cloud support, that's a pretty bearish sign. And you really don't want to be reconsidering the chart until it gets back above the cloud. That's why, like in April, a lot of things broke below the cloud. Tells you to be, avoiding until and unless we get back above the cloud resistance, and that suggests back to a positive trend. So I do think it's helpful. I often will use it when something has been in a strong trend and starts to turn lower, or when it's been selling off and just starts to turn higher. That's when I tend to use the cloud more often. I have worked with Japanese banks and trading desks where they primarily use candlesticks and the Ichimoku system and have great success doing so. So much respect for that general approach. Super popular in Japan, which is it's one of the number of Japanese charting techniques that have really become more popular in the U.S. Over the last series of decades, I would say. All right, one more. That was kind of a longer question, and sorry for that. I didn't mean to be so long-winded. Tony, I don't remember answering a question for yours, but I will answer. Can you take a look at CAT? For sure. Shall we? And I do see the comment. I don't have, as I mentioned, I don't have all the lines on here. I just look at the cloud. As you probably learned from my process, I simplify as much as possible, right? I mean, my goal is to look and try to simplify, not complicate. The problem I have with the full Ichimoku system, it's like 3 different indicators in one. It's a lot. It's sort of like a spaghetti thing that happens on your chart. It's a little much for me. So I kind of simplify with the cloud. The lagging span, though, 100%. I get it. I've used it. I get the argument for it, but it's not something I use regularly. All right, looking at the chart of Caterpillar. So this is one of those charts that has been long and strong off of the April low. When we talked about charts that have been working, Caterpillar is definitely one of those examples. I mean, going into the April low, this is a stock that was in full distribution mode in Q1. after a rally in mid-January, sold off pretty consistently. But from early April now to the end of July, it has been higher highs, higher lows. So a chart like this, I assume that trend is going to keep going pretty much to infinity. I know that's not fair, and it probably won't happen, but that's why we have the beautiful 21-day exponential moving average in green. Charts like this are fantastic. Even more fun if you bought it back here somewhere, and if you're sitting on some fantastic paper gains. I was actually doing an interview with Adam Koch. He has a fantastic podcast, really targeted to financial advisors that I did an interview with him earlier today. It's not released yet. I'll share it with you as soon as it is. But one of the things we talked about was one of the biggest challenges I think people run into with investing, where I think charts can be a huge help, is a position like Caterpillar is a good stock as long as it keeps going up, right? But at some point, it's going to stop going up. And what happens is we often sell way too late. We ride it higher. We're super, super happy. And then when it starts going down, we start justifying why it still makes sense to own the stock as it goes down 5%, 10%, 20%. Has that happened to you? I can't see your camera, but go ahead and raise your hand wherever you're at. If that's happened to you, I know it has. Go ahead and admit it to yourself and others. It has, right? And that's a perfectly natural thing. There are a number of behavioral biases that explain why your brain has so much trouble selling a position after it's been working so long. And part of that is the emotional attachment you have to the stock that's been working. Charts are fantastic at not telling you what it's thinking or what the chart is thinking, but just telling you, here's what's happening. This chart that's been working is no longer working. So in this kind of position, in this kind of chart, I think you go into full trend following mode. Use the 21-day exponential moving average in green. That's what I would use. The chandelier exit system is another one I'm a huge fan of. That's based on average to range. Those are trailing stop techniques that will tell you a brief pullback that's still okay versus the beginning of something more significant. And if those alarm bells go off when we start to break the chandelier exit and or we break the 21-day exponential moving average, that is when I would not be thrilled to own Caterpillar anymore. For now, long and strong chart going up and to the right. That's a bullish chart. Great questions, by the way. We only got to a couple of them, but some really interesting ones in there. I wish we could go through more. I'm going to add the ones we didn't get to the mailbag. Please be watching on Friday. We'll answer some of these other questions. You guys always do such a great job throwing some thoughtful questions along the way, and I'll get to as many as I can. But for now, I will say, have a fantastic evening. Hang in there with earnings, with the Fed, with economic data. We'll be back tomorrow after the close on Wednesday to debrief on what we've seen from the markets. But in the meantime, have a great evening. And remember, it's always a good time to own good charts. Take care, folks.